Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
To the special TV18 broadcast of the big macroeconomic number, the July inflation number that's being announced at 4.17. It is the best news that the economy could have asked for. The poll done by CNBC itself was expecting the number to come in at 4.5, mind you, no less. The range of expectations were between 4.4 and 4.8. Nobody was even giving a 4.3, but the number actually comes in at 4.17. So this is excellent news. The numbers were expected to be a little impacted by the year-ago inflation. Year ago, mind you, inflation was as low as 2.36 in July. This was the post-demonetization impact that you were feeling in food inflation. In particular, food inflation had contracted in the previous 2017, May, June, and even July. It was very soft. So on a year-on-year level, if you are able to generate only a 4.17 inflation, that speaks a lot for the inflation trajectory itself. It's quite clearly not something we have to be worried about. And clearly, this will have an impact on both bond yields and on the currency, both of which went for a toss today because of the Turkish epidemic. But this number should definitely warm the hearts. We are still waiting for more details in terms of food inflation, which should be with us in a minute. But the headline inflation itself is extremely important and positive. We should be getting the numbers in just a minute. We should be getting, that's the fuel and light inflation coming in at 7.96%. The food inflation has come in at 1.37. Now, that's a fairly decent number that we've got. July 2018 coming in at 1.37. The year-ago number was minus 0.36. So on such a low inflation, if we are able to get an inflation of just 1.37, that clearly indicates that food inflation is practically non-existent and the disinflation in food prices continues. Last month, we had still reported a food inflation of 2.91. So clearly, this is an excellent number. We will be giving you more details as to what are the components of the inflation numbers. But let me get the first quick comment from Soumyakanti Ghosh, the chief economist of SBI, who has joined us in a minute. We'll also have, we have Indra Nilpan of IDFC and Tushar Arora of HDFC Bank. So that's three bankers who have joined us. Soumya, you go first. 4.17, even for a normal dove like you, this should be a very good number.
Yes, actually we are expecting 4.25. So it at 4.17, it's a very good number. And the good thing is that, as we have been saying repeatedly, the core has started to fall, and this month the core has declined to 6.29%. And this decline in the core even comes on the back of, as you know, in every month, July and January, the housing index is revised, which is, and this comes even after the possible increase in the housing index to 6.29. So my sense is that the core will continue to decline, and this month number is 4.17. Next month number could, we were expecting earlier to be closer to 4%. Now it seems that it might go below 4%. Okay. So and the other important thing that I mentioned about the base effect, but the base effect should have actually held the CPI to moderate last month, because this month base effect was a little bit adverse because it has moved up. So from all points, I think it's a very good number, and hopefully the trajectory continues like that, then we can see some very good numbers going ahead.
Okay, well, trajectory continuing, we will have to really wait and see, because we will know the impact of the MSP only in the months to come. We could not have had the impact of the MSP just yet. So maybe the next month will be a slightly better indicator, hopefully, if some of the MSP implications are already in the price. And secondly, we will have the rupee depreciation impact, provided, of course, the rupee stays soft. Today, of course, has been a seminal fall. That impact we will know only in the months to come. But for now, it is a celebratory number. Indra Nilpan, would you want to guess whether some of the weakness, both in bonds and rupee, can be erased by this 4.17 number tomorrow?
May not be because of the CPI, but maybe because of the fact that we have seen a huge correction once again in the lira, given the fact that I think Turkey has agreed to release the pastor back to the US, which has actually sort of corrected for the lira in a very significant way. So that could be a bit of a breather for the currency and the bond markets. But I think overall, given the 470 number, our own estimates were at 415. So I don't think we have anything to sort of really comment on that, except for the fact that for us the core inflation still continues to be above 6%, and that's I think something that will continue to keep the RBI worried.
Okay. Well, I will now be able to read out the other numbers to you, gentlemen, and to our viewers. Cereals inflation remains low at 2.92%. Meat and fish 2.26%. Eggs, the only one that's a little expensive in the protein basket. Eggs up 7.4%. And then again, milk, we know we have a problem of plenty there, and people looking to get rid of stocks. Milk inflation at 2.96%. Oils and fats 2.79%. I mean, just about anything you touch is about 2 something. And then there is a negative number, 2 big negative numbers. Vegetable inflation minus 2.2%, and pulses and pulses products once again minus 8.9%. Sugar and confectionery, another problem hit by plenty, minus 5.81%, and that's what is giving you a food inflation of a food inflation of 1.37%. Fruit is the only one which is standing at 6.98, and as I told you, eggs at 7.4, but all told 1.37. Inflation is what you would call disinflation continuing in food, but housing inflation at 8.3, and that was the point that Soumya was pointing out. Housing inflation has come in higher because of the adjustment that takes place in July. That's coming in at 7.3%. Clothing has come in at 5.28. I'll just be there with the other numbers. Housing is the worst, of course, with 8.3%. Fuel is 7.96, taking into account some of the rises in petrol and diesel. Let me just give you the services numbers, which is most important. Miscellaneous as a whole is 5.8%. Miscellaneous is largely a collection of services, and that at 5.8 quite clearly is higher than the goods inflation. In India, food inflation and fuel inflation, food inflation in particular are very much under control, but services inflation, or what closely resembles what the economists call core inflation, is the one that is high. So miscellaneous is at 5.8. The components are personal care and effects at 5.26, educational services at 5.77%, recreation and amusement 5.06%, transport and communication, where of course a bit of fuel prices also come into play, 6.55%, and household goods and services at 5.08%. I must add, health at 5.8%. So all services are very close to 6%, but all food items are below 2% or around that level. That's the story. That's the story of inflation in July in all. We will get to Suyash Chaudhary, the head of fixed income at IDFC, in just a minute. Let me get Tushar Arora's views. Tushar, the 4.17 will want to make you review the inflation numbers in the coming months as well. This is an unusually low number, isn't it?
Well, it's certainly a good news, and I think it is lower than what we expected. We were at 4.5, similar to the consensus. But I wouldn't go to an extent of calling this as a very celebratory number. I think what are the uncertainties, if we may ask? I think RBI is worried about the MSP hike, not just for Kharif, but also for Rabi. They are taking a very long-term perspective of inflation, as was outlined by the last policy. They are worried about exchange rate risk, which is still we don't know where it is heading. They are worried about core inflation, and core inflation, although it is moderated, it still remains high. And what are the things they can really impact through monetary policy is really core and services side of the inflation. So I think this number is good, but it doesn't really give us any information of the kind of impact we can expect from the MSP or with output gap closing down maybe several months down the line. So I think a good number, but it still doesn't take out rate hike out of the picture. It is still there on the table because of all those uncertainties that exist going forward.
Okay. I'll come back to you to ask you whether it would be 3 back-to-back rate hikes when inflation falls to 4.17%. but I think they may have one more inflation reading before the next monetary policy. Let me get one market view, and I'll come to you economists for your rate view. Suyash Chaudhary, the head fixed income at IDFC Mutual Fund, joins us. Suyash, what's your expectation tomorrow itself and in the near term on yields?
So, Lata, near term, the narrative is getting dominated somewhat by, what's happening to emerging markets led by the Turkish lira. This obviously, is a counterbalance to what's been happening and, the lack of trader appetite. More broadly, this number will serve to take out any residual expectations of an October rate hike, provided there is no massive sell-off in the currency from here on. We would expect if any rate hike has to happen, if at all, will be in the Jan to March quarter, when two things will be clearer. One, the future trajectory of vegetable prices, which is a big part of why these divergences are happening. And second, what is the lagged impact of the MSP basis the execution there. So bond market should be relieved because this is a counterbalance to what's been happening in EMs. Also, supply demand is set to turn more favorable starting October if the OMO theory still stands, which is that the RBI will have to move to address core liquidity deficits over second half owing to currency in circulation leakage.
Sure. So basically, where are you seeing yields tomorrow?
Well, that's basically a shot on a dartboard, essentially, but
No,
I would
not
think
really. I mean, our bond markets have been very well behaved and very ranged. This is a good inflation number. The poll that was running was 4.5. I saw a couple of other polls which said 4.4, but nobody really said 4.17. So you don't think there's a positive impact on bonds tomorrow?
No, absolutely. From this data, the only thing one fears is what happens overnight to the emerging market narrative.
Okay.
So on this data alone, clearly there is a 3-4 basis point rally, especially because there was a sell-off today, which was largely not of our making. So I would expect that to happen. Also, market positionings are quite light, generally speaking, so that should also help.
Okay. Well, actually, let me come to Soumya on the future trajectory of inflation. Starting next month, we actually have the base getting higher and higher. Core inflation will jump. I mean, it's a rather massive jump, right? In August of 2017, it goes up from 3.9 to 4.5, Soumya. So we should logically start seeing the core inflation coming down because of the base effect. Do you think, Soumya, what is your trajectory of core inflation and your trajectory of headline inflation from now to December?
Yeah, before I answer that question, Lata, just two important points regarding the MSP we found out. I think we just tracked the Mandi prices and the MSP prices. There are two very interesting trends playing out as of now. The pulse prices have actually continued to decline even after the hike in the MSP. So that is one factor which will negate the possible adverse impact on the MSP one. But on the other hand, the prices of the coarse cereals and paddy has actually increased by 9 to 15% post the MSP hike. So it will depend on which weightage is higher in the CPI basket, and the MSP impact will play out exactly like that. Now, coming to your point on the inflation trajectory, yes, core inflation next month, most possibly if nothing dramatic happens, will go below 6%, and it is likely to decline in the further months. And we are seeing core in between 5 to 5.5, with mostly at the lower end by March 2019. And the headline CPI most likely to go below 4% next month. Then it could actually trend up a little more in the subsequent months. November, December could be again closer to 4% or below. And from January to March, it could actually head towards 4.5 to 5% band. So overall, even if we assuming that, there could be, if the RBI is convinced about a 4% inflation target, I think in all the subsequent meetings with the RBI will have the inflation numbers that will be on the table, which will be very favorable in that current context.
That's very important. If the next number is going to be below 4%, that's when you have the October policy, and therefore it would be extremely difficult to justify 3 back-to-back hikes, especially when inflation is reading below 4%. There is a tyranny of the present, I guess, which will catch hold of or which will take root in the Reserve Bank. And maybe there won't be a necessity either. They may want to look at how the MSP rolls out. Suyash, no, sorry, before I come to Suyash, Indranil Pan, what is your trajectory and what are your expectations from the Reserve Bank?
Well, my trajectory is more or less similar to what Shaumo pointed out. I don't think there's a rocket science to the trajectory, and given the fact that there are so many uncertainties, obviously neither the RBI nor the Indranil Pans and the Shaumos have possibly been able to factor in all the uncertainty. So given this situation, I think from an RBI's perspective, if their own inflation projection is above 5% for Q1 2019, they would possibly be wanting to take the safeguard much ahead of that rather than later. And also given a situation where the currency markets are volatile and will probably continue to be volatile, given the fact that there is a significant sort of economic problem that is emerging within the emerging market space as a whole. If you notice, even the CNY has actually been sort of depreciating in a very significant way.
Yes.
So all those taken together, I think the pressure on the currency markets is, and the implication of that on inflation is also very relevant for the Reserve Bank of India. So I think the safeguard has to be earlier than later, in my opinion. So I would not take away the October hike from the table immediately in a swift go, just by looking at this inflation number. And sort of look at more the credibility point that the RBI had been sort of mentioning in a very significant way, which necessarily means to say if their own inflation target or own inflation forecast is above 5%, they can't sort of sit quiet even at this point in time.
Okay. What do you expect on the currency tomorrow, Indranil?
Well, I think the currency is clearly above the 69 level at this point in time. And I think, as even Suyas pointed out, that a lot of the movement of the currency is not immediately our doing. It's more an external issue. And as I pointed out, that given the fact that Lira has corrected in a significant way post the announcement of the release of the pastor, we can sort of see some amount of retracement in the currency, retracement in the bond yields. But I definitely don't expect the currency to go all the way back to 68.30 from where it started this journey.
Okay. Your thoughts, Tushar? You said rate hike in October, right?
No, I mean, I said the rate hike is not out of the table.
Okay.
But if we just look at the August print, which can be, I think, again expected to be lower than 4.5, RBI wouldn't really get a clear picture even with the next inflation reading. What they would be more interested would be, I think, in the readings for September and October. That's when, you know, the MSP impact would start kicking in. And as Indranil pointed out, I think we don't really expect a prolonged pause from the RBI. Reason being, I think they are focusing on June next year. They're looking at a long-term inflation trajectory, and they believe there's a gap, there's a transmission gap in terms of monetary policy working. So they would like to act soon, but purely from inflation perspective, they won't get a clear picture by next month. A lot would depend how the currency behaves, how the emerging market risk pans out, because that would be one important criteria in terms of imported inflation to consider. So October is not out of the table, but a lot depends on the currency risk.
Okay. Well, Suyash, you said that the 10-year bond yield could give up about 4-5 basis points after it closed at 7.8283 today because of what was happening in the currency markets. But what is a more, more near-term trend, like say up to October? Do you expect it to remain in this range, 7.77 to whatever, 7.885?
Sulata, it's important to recognize some of the underlying dynamics of the bond market have changed for the better. One of the aspects is a lot of, supply that was stuck with traders has been taken out, courtesy the 3 open market operations the RBI has done. There has been some FPI interest amounting to close to 7,000 crores over the last 10 odd days. And, there has been some ALM buying also from the private sector, which has taken out some trader positions. So, unlike a couple of months back when the market used to feel quite heavy, right now positions are lighter. Having said that, one key trigger for the market is when the OMO schedule resumes. Liquidity calculation thus far suggests that sustainable OMOs actually come around somewhere closer to mid-October. So if you see historic currency in circulation trends, over October to 15th November, the system should lose around 1 lakh crore of currency, due to rise in circulation. So we basically have to navigate the next couple of months. The sense is if globally things are stable, from here on that is, we should broadly respect a band of 770 to 790 on the 10-year. If globally things were to change, then obviously this band changes. But yes, there is relative stability now compared to what even was the case 2 to 3 months back.
Would you want to take a stab on the rupee as well, Suyash?
Rupee will obviously depend on what EMs are doing, but, one noteworthy thing is the rupee's relative underperformance period seems to be past us. So if you see what rupee is doing compared to other EMs, we are now faring quite okay on a relative scale. It is also possible that, at least half of our BOP flow, which is supposed to be negative this year, is already past us, and the next half year will not see as big a flow risk as we have already seen. So I would think the relative period of underperformance is broadly over, provided oil remains where it is. Okay. So one noteworthy thing also is oil is 10% down from when the rupee was underperforming similar EMs.
Okay, yeah, but today the expectation was that currency, the commodity market, especially fuel, could also crumble. It's largely stood its ground and remained somewhat close to the $73 mark. The news is that US putting any deadline to the setting free of the pastor is false, is what some reports are telling us. But we still await word on whether the crisis is abated. At the moment, it doesn't appear so, because we still have most of the currencies trading weaker. For instance, the Brazilian real, which has started for trading now, is down in the morning by 1.2%. The South African rand continues to remain lower by 1.83%, though at one point in time it was down 2%. So there is an element of weakness, but it is not as bad as it was earlier in the morning. What's your sense, Soumya? If the currency were to now, let's assume its new range is 69.50, a pivot of 69.50, will that change inflation numbers?
As of now, I don't think that that will obviously have an impact on the WPI number, but I am not sure about too much of an impact on the CPI number. Okay. Even if the rupee stays at the current level, because the oil prices have also declined, so there is a counterbalancing factor. So there will be an impact on WPI for sure. But CPI, I think it needs to be seen how much will be the impact, because in the past also, as the rupee has depreciated, oil has gone up, the impact on the fuel component of CPI was not that significant. So we have to wait and watch what is the impact on the rupee depreciation.
Okay, but Soumya, what are your treasury guys telling you about the currency? Are they seeing a new level of 69.50, 70, or do you think this is a very brief impact of what's happening globally, and the rupee will slide back to the 68.50, 69.10 range?
See, I have an uncanny feeling that the current level of, and also given the inputs on the treasury, is that the rupee could actually bounce back from the current levels. May not be to the levels of 68.30, 68.50 what we are observing, but at least a bounce back from the current levels is imminent, because there could be some more good numbers which would be coming in the month of August to get the GDP data, and also the fact that the Indian numbers, the macro numbers, the inflation numbers, today's inflation numbers, the GDP numbers, is not that bad to trigger a widespread panic in the market. And also the fact that if you look into the portfolio inflows, they have revived in the last 10 to 12 days after the sell-off in the month of May and June. Okay. So if you take that, all that factors into consideration, and I think Indian currency has been the best performing, third best performing currency in the last couple of months if we compare all the emerging economies. So from that point of view, I think a bounce back from the current levels looks the most desired outcome if you look into the macro numbers.
Okay, bounce back, but not quite to 68.30, 68.50 levels. Take your point. Very quickly, I want wrapping comments, and I want them to be monosyllabic answers if you don't mind. Tushar Arora, how many rate hikes and when?
I think one for this financial year, but can't really say about October with confirmation. I think October would be 50-50.
Okay, Saumya?
Yeah, one for the next year. I will not say this year, I'll say one for the next year.
Do you mean financial year?
If the trajectory remains on track.
One in the financial year, that's before March 31st?
I'll not say financial year, I'll say
12 months, okay.
It could be a possibility, but most likely it should be in the beginning of next year.
Okay, next financial year. Okay, Indranil?
One in October, one more, that is the last in October, with still a 65% probability, I would say.
Okay, and very quickly, what are you all expecting by way of year-end inflation number now that the current number is at least 30 basis point lower than the CNBC TV18 poll? So, Tushar, March 31st inflation?
For today's release, we had a number of 5.3.
Okay.
I think it would come down to around 5.1% after this.
Okay. Yes, that it would. But okay, I guess there are still two wild cards in terms of rupee and MSP. I think you said 5%, your March 31st inflation, Saumya?
March 31st inflation number, we are around at 4.8% or so. So it's closer to 5%, but not exactly there.
Okay. And Indranil?
5.10. I'm not changing because my numbers this month were pretty close to the actuals.
All right. Thank you very much, gentlemen, for joining us. The news from the macroeconomic front is that the inflation number for the month of July is coming at 4.17%, much lower than the CNBC TV18 poll of economists who had put the inflation number at 4.5%. Our panel of experts believe that there is one more rate hike possible this year, if in fact one of the economists expect two. But there is, of course, the other one who expects perhaps not in this financial year at all. The positive inflation number is likely to bring down bond yields by a few basis points. Tomorrow it had risen to 7.82 today. Maybe an amelioration below 7.8 is possible, of course, other things being in global markets in even mode.